In the latest of our jargon busting videos, we're going to look at the idea of trading on margin. Hello and welcome back, I'm David Jones. Now last week we talked about the idea of using leverage to trade, where a small sum of money controls a much bigger financial position. And the reason that this is important is if you're trading foreign exchange, contracts for difference, spread betting, all this sort of stuff, you are using leverage, you're trading on margin. And that's what this week's video with Trading 212 is all about. The idea of using margin to trade. What are the costs? What are the risks? What are the rewards? And as ever, some real examples. So let's just refresh our memory. What is the idea of leverage? How does it work when it comes to trading CFDs or FX? Then we'll get into some real examples. Let's do a quick recap of leverage when it comes to margin trading. So the whole idea behind leverage is a small amount of money can control a much bigger financial position. For example, in something like foreign exchange, you might have a $10,000 position and the leverage available on that, or the initial margin requirement, might be only 5%. So you're in a position where you're controlling $10,000, but you're only tying up, in this example, $500 of your cash. Okay, so that's your total position, and that's what your initial margin requirement is. Of course, if the position moves against you, you need more money in the account to cover any losses, but that's your initial margin. On things like shares, the margin requirement may be a bit more because they can be a bit more volatile. So let's say the margin requirement on an individual share was 10% for the purposes of this example. So you open up a position using contracts for difference, CFDs. Let's say you open up a £1,000 position on a particular share. The margin requirement is 10%, so it ties up, in this example, 10% of £1,000, so £100. Don't forget, you do get this money back. When you close out the trade, this money is then freed up into your account, plus any profit or less any loss. You know, it's effectively just a deposit to secure that position. But if there are any running losses, there'll need to be free money in the account to cover those losses. As usual, I think it's much easier to explain this in the real world when we actually do some trades, and we'll do that in a minute. So when we're trading on margin, there is that initial margin requirement. As you saw from the examples there, we can have X size of a position, and we end up having to put a percentage of X up as deposit, as the initial deposit when we open the trade. And of course, if the trade moves against us, we need more money in the account to cover any running losses. But as usual, let's take a look at a couple of real examples. So let's place a couple of real trades and see how this idea of margin trading works in the real world on a trading platform. So we're on the platform. Let's go step by step through a trade. We're going to do pound US dollar, zero spread. So the bid and the offer are the same. I'm going to right click on the screen and open up the detailed trade box. So the trade size I'm going to do is for 10,000. So I can either scroll up and down here, or I can just type it straight in, 10,000. Here we go. So I'm ready to trade. Let's say I think the pound is going to go up against the dollar. If I click on confirm buy, my trade will go through. But just look down here first of all, margin, £50 margin. So for this position, for a 10,000 exposure, pound US dollar, it's going to tie up £50 from my account. And the interest rate financing, which we'll come to in a few minutes time, that's detailed down here. Let's put the trade on, click on confirm buy, and we're going to buy 10,000 pound US dollar at 134.37, wherever it's trading now. So our trade has gone through, and you can see it down here in my open positions, pound US dollar zero spread, 10,000 I bought, 134.37 and a half is where I was filled. There's the latest price, and this is what we're talking about. This is my margin requirement. So I've got £50 from my account tied up against this trade. If I choose to close this trade now, that £50 gets released back into my account, plus any profit, less any loss that I've made on the position. Let's do the same thing again with an individual share, just to see how this margin works. So this is the UK oil giant BP. So we decide it's trading, where is it trading at the moment? Just above £5. So we think, well, actually, the price of BP is going to go up over the next few weeks. Let's say this is more of a longer term position for us. So again, let's open up the detailed trade box. And let's say we're going to be conservative. We're only going to trade 100 CFDs on BP. So 100 CFDs at just over £5 a share gives us an exposure of just over £500. Okay, it's 505 is the price of the share at the moment. We're buying 100 of them. That's just over £500. But because we're trading contracts for difference, CFDs, we're trading on margin. So we're not tying up £500 from our account. You can see down here, the margin requirement for this trade is just over £25. Okay, so it's a 5% margin in this example. And that's it. Click on confirm buy. The trade goes through and you can see it down here in my open positions. BP, buying 100, bought 100 at 505.26. There's the current price. And there is my initial margin requirement. Okay, so we have this relatively small sum of money controlling a just over £500 position in the shares, in the CFDs of BP. And just for the sake of completeness, we've jumped forward one day. So it's the next day after we've placed those trades, just to show you the other aspect of margin, the fact that there's financing. Here we go. There's our pound US dollar trade. So for holding that overnight, the 10,000 position cost me 67 pence in margin finance, and the BP CFD, just over £500 position there, that cost me 13p. So that's a cost every day because in effect we're borrowing money to trade. So hopefully that's all straightforward enough. It's important to understand that your initial margin deposit, that's not all the money you can lose because you have the much bigger financial position. The benefits of trading on margin, if you get the direction of the market right, you end up getting more bang for your buck because you've got this bigger position controlled by a relatively small initial deposit. If the market moves against you though, clearly you can lose more than your initial margin deposit. So it's always important to weigh up the risks, the rewards, and use things like stop losses. You saw there was a financing charge. So every day, because we're trading on margin, because in effect we're borrowing money to trade, there's a small adjustment to the account, particularly as we're in a low interest rate environment. This is pretty low, I think, as you saw, but it is one of the costs of trading on margin. So hopefully we've explained it fairly easily there in this short video. It is pretty straightforward. It's just this idea: a small amount of money controls a much bigger financial position. But if there are any questions about this or any comments, just leave us a message down below in those comments. We do read all of them. If you like the video, click on the thumbs up, and if you're not subscribed, if you click on, there should be a subscribe button there and the alarm bell notification down there somewhere. You'll get notified every time we upload a new video. But for this week, from me, David Jones, and Trading 212, we'll leave it there, and I hope you have a good trading week.